In investing, spreadsheets don't lose money, assumptions do. Now, the problem is most underwriting breaks in three places: optimistic rent lift, underestimated expenses, and rosy exit caps. Now, that combo can make an average deal look great on paper, but disappointing in real life. In this episode, we're going to discuss the exact stress tests we run on rents, expenses, and exit caps, our kill criteria, and how we convert uncertainty into conservative investor first decisions. Mark, great to be here today. How are you doing?
Yeah, I'm doing great, John. Doing great. I'll tell you, the weather's starting to turn up north, and I was just up there last week, just north of Toronto, and I'll tell you, we're now that I'm back down in Naples, Florida. The timing is very good to be coming down, to be down here because during the summer, it's of course it's better to be up north, and around this time, it's actually better to be down south. So we'll say very very blessed to be in this weather down south. Is that I've heard flurries are starting to happen. It's the beginning of November up there
Yeah.
right now. So yeah, it's a very interesting time. Christmas is upon us soon as well. And you're going to start to hear all the Christmas music going at all the stores and whatnot. But it's my favorite time of the year out of
Yeah.
the entire year. Christmas. How is it for you, John? Is Christmas one of those times? It's one of your favorite, or are you more of a Thanksgiving guy?
It's funny. I mean, both really. They both have their kind of features and benefits, I suppose. But Thanksgiving, it's funny. As I've gotten older, I've really learned to appreciate that holiday. And my wife and I both enjoy cooking, so we've been hosting the last number of years. And it's just for us the gratitude and just hanging around family. And generally, we'll get together with some friends over the long weekend as well, kind of the friendsgiving thing. So yeah, I do love that. But as somebody who still has kids at home and one's in college, but just the joy that Christmas brings is just hard to put into words, right? Just how it makes you feel as a parent to be able to provide and have just those moments, right? I mean, it's funny, as a 44-year-old, I still have like very clear memories of some of those great Christmas holidays with my parents and things like that. So helping to create those memories for my kids is obviously truly special. But yeah, I'm looking forward to the holiday season. It's a great time to reset, recharge, but also to think about what you're grateful for, and that we, and I say we, but my family, we've been fortunate in life and we've been blessed. And so, just kind of keeping that all in perspective, right? And I think that's what the holiday season's all about.
Yeah, no, right on, right on. And so, the end of the year comes a reflection of what happened in 2025, and then excitement for planning the year 2026. I know that was something we're discussing as
Yeah.
to that next planning session for for 2026. But 2025 was a solid year. Deal flow was down this year big time. We were still able to take down three assets this year, which was we just took down the 114 units in Atlanta, Georgia, and then we got that 66 units outside of Charleston, and then we got the smaller one, the 36 there at the beginning of the year, in between our two other assets in Charleston. But overall, it was a good year based on the low amount of deal flow that are out there. But 2026 is shaping up to be a very very strong year as well. We're
Yeah.
looking to continue to build the team out and make sure we're ready for that next asset because we're looking at deals every day, right, John?
Oh yeah. Oh yeah, absolutely. For our investors that are listening to this that are currently in our deals, we're starting to look at some new markets. So that's a very exciting time. It's a very thoughtful and a lengthy process. We want to make sure that, we've had a lot of success in Charleston, Tampa, as well as now Metro Atlanta. But we want to be very thoughtful and make sure these markets we're choosing are the correct ones that'll deliver on the returns our investors want. But that's exciting, right? Getting to know a new market, and really we did a deep analysis on 50 markets, and so now we're looking at those top 10 choices and doing further research into the sub markets. But what's exciting about that is once that's completed, when new deals come in, we can very quickly see, because it's the idea, like if you say Dallas, Texas, for example, it's a massive area. I mean, it's probably take you a couple hours just to drive from one end to the other, and it's also hyper local in real estate, right? So just getting to know the different sub markets and those key pockets that have the population growth and all the demand drivers we look for. So we've completed that in a few markets, and yeah, so I think 2026 will be our best year yet. So I'm really excited, to put a bow on 2025 and continue to bring some incredible deals to our investors in 2026 and beyond.
100%. I think that right now is one of the strongest times to be buying right now with what we're seeing with lack of new builds hitting and being delivered to the market. And we'll just say the how much pricing we've seen come down since the peak of the market in 2022. It is go time right
Yeah.
now. So, we're really, as you know, John, with our investors, we're really encouraging our investors to, really step up right now, because that encouragement, I think we're going to be looking back in 2 to 3 years. The data is telling us this. And John, that's actually a good idea. We should be you doing a future podcast here as well on the data of why we believe the
Yeah.
market is going in one direction moving forward, that from a deliveries and overall cap rates expansion that we've seen, and interest rates lowering and all the rest. We'll do a future episode on that, but definitely an exciting time. And if you are interested in taking that next step and learning a little bit more of what that actually looks like, what are typical deals looking like, you can actually go to fulloutinvesting.com, and you'll see a video there explaining our entire process from start to finish. And then there'll be a link there that you can book a one-on-one call with either John or myself on that, to get a better understanding what your goals are, and if this is going to be a potential good fit for you. So go to fulloutinvesting.com. So,
Yeah.
John, one of the things that I get asked a lot is like, okay, what's the potential downside in a deal? And then it's like, okay, well, the numbers that you're providing me, how do you stress test and pressure test these numbers? Like, you just winging them? And so that's what this talk's going to be about, is how do we pressure test not only the rent projections that we have, but the overall expenses, and then what the exit cap rates are going to be. These are like three really big parts of the deal. It's like you want to make sure that your projected rents when you go in and renovate, that your whatever you're projecting, you're getting that right, because if you're off, that can make a significant impact to the overall returns. The second is your expenses, making sure that the numbers that you're factoring in your underwriting at the time of drafting the offer is, they're solid, and you're not just taking what the broker is telling you. You're actually stress testing and you're verifying those expenses. And the third one is, okay, what's the exit cap rate, so your exit sale price that you're projecting, and are you conservative on that or not? And so that's what this episode's going to be about. And I think this is going to give the listeners some really good insight as to the way that we think about these deals.
Yeah, it's so interesting how headlines can be very misleading in a sense, right? So, for example, and it's all market dependent. Some markets are seeing very positive organic rent growth. Some are still flat, in some cases negative. Now, that's driven by supply and demand, and the new wave maybe of supply still coming online. But I mention that because, in effect, we're almost looking for a needle in a box of needles, right? So by that, I mean, there's a lot of deals out there, but we're trying to find those special deals that really, in an interesting way, what we're effectively looking for is like poorly managed assets. So, a good example is when we first took down our Largo deal. At that time, at that moment, the submarket was experiencing negative rent growth, organic rent growth. It was like 0.4 negative, right? So it wasn't extreme. And when we closed that deal, and I'll get to why we still believed in that deal in a moment, but when we closed that deal, I actually connected with an operator. Now, I will say I like this guy, and we built a relationship, but they bid on the deal. So I think there was a little sour grapes there, just to be clear. But he was kind of poking a little bit, saying, "Oh, you paid too much, and the rent growth isn't going to be there." And within 30 days, we were, leasing classic units with like $150, $200 rent lift, right? And far exceeding the market performance. But the bottom line is the deal was just so poorly managed before. They weren't maximizing what was already there. So once we implemented some of our value add in our 28-day transformation, we immediately saw that lift. And we're now getting 8 and 10% lease trade outs in some cases on our renewals. So, it's one of these things where you have to look at the headlines, you have to be intelligent and make sure you're in the right markets. But then once you study those markets, finding those deals that still have that lift available. And there's really a three-layer defense here, right? Like how do we really prove this out? So First, it's in the data and comps, right? So we look at the market data I just mentioned, what's happening in the sub-market. We also, level up a little bit and look what's happening in the market overall, and sometimes in a market you see a lot of in migration. So within the market, so say in Tampa, people are moving from one area to the other for affordability, better schools, whatever it might be. So we want to look at the full market, but we really focus on that sub-market. And then, of course, we're digging into the performance of the deal itself, right? That rent roll analysis. So, what's currently happening? And with a deal that, is maybe less effectively managed, what you'll often see is that they just haven't been pushing rents that aggressively. And so, for example, a resident might be in there for 9 or 10 years and they're just getting 1 or 2% rent increases every year. But the rental rates in that area have gone up by 30% in that amount of time. So we have to be careful because of our people first approach. We just don't go in and, jack somebody's rent up 20%, but it shows that there's room there, right? And then, of course, that review of the financials, that T12 analysis. And then we look at the most recent T3 trends. So, in other words, the last 3 months, and we annualize those. Are they trending in a positive direction compared to the overall T12 or in a negative direction? So that's really number one. But almost most importantly, it's the boots on the ground. And we've talked about this on prior episodes, but we personally, and when I say personally, like Mark and I and our acquisitions team, tours every rent comp before we make a decision. We don't just go on apartments.com or one of the platforms and poke around. We go to the asset, we go to the leasing center, we ask for a tour, we look at what they're doing in terms of renovations, what they're offering, the unit setups themselves. And in those rent comp tours, we've walked away from some deals. I mean, I remember one very specifically in Smyrna, Mark, where it was on the last one, but it was the closest one to the property and they were just much nicer units. Bottom line, I mean, the floor plans were fantastic, the renovations were great, and we just said, look, I don't think we're going to be able to get the rents we thought we were going to get because they're actually renting for $50 less than we thought we would be able to get. So that boots on the ground intelligence. And by the way, when we're on property with these comps, what we found is most of the leasing managers, love to talk and share. And so we just ask them, what are you charging for? Is there any other income you're generating? Do you have this kind of a program? What's the leasing velocity look like? And they'll share a lot of that information. So that intelligence is so powerful. And so if you're listening to this as an investor, make sure you ask that question. If it's not Faris Capital, are you personally touring these rent comps? Where did you come up with these rent assumptions? And then thirdly, we leverage our third party property management team to sort of do like an external check, if you will. So they're going to run their own analysis. And what we do is we don't share our numbers. We don't share any of our data or intelligence that we've come up with. We don't share our underwriting. We say, we like this deal. What are your thoughts? What do you think we can get? And they'll actually go out and tour those rent comps, run an analysis, and come back. And then we take those numbers and compare them against ours and look to see if we may need to make any adjustment. And interestingly enough, we'll often even get feedback from our lender because before we submit an offer, we're sizing up the loan, we're sharing some of the financials. And so occasionally the lenders give you some good feedback as well. A lot of these groups operate hundreds of deals in the market you're in. So they have intelligence that they can share along the way. So that's really like the kind of high level defense that we do just when it comes to, ensuring that our underwriting on our rent growth is conservative and achievable.
Yeah, for sure. So yeah, that sets the stage for rent growth, expenses, and also our exit cap rate. So it's like the preliminary, and now we're getting into like the rent pressure testing on this. So the big one, as you mentioned, John, is you got to go look at the comps. So the comps are comparable properties in the area, boots on the ground. That's really important. And when we're doing it, we're making sure we're looking at the same vintage. So vintage is basically the age of the assets, the way that they're finished as well. Bed bath mix. So it's like you could have 100 units, but you have 101 bedrooms or 100 different, we'll say 31s, 32s, 33s. Like
Yeah.
there, there's a difference there. You got to really factor that in. You got amenities that we're comparing. School zones, crime's a big one. That's where that market, high level market is analysis is really important. And it's really important when you're starting to look at you go through and you look at you narrow it down to we'll go through like even like 6 or 7 different comps, but getting very clear of okay, these ones are the most important. And that's where, John, that one example that you gave, we went to the very last one, and it was like we looked at it, and we're like, this is better. And
Yeah.
so it's so important because you can start to get locked into this trying to prove yourself right. It's like you're
Yeah.
looking for the answers that you want to see. And so you gotta really look objectively as
Yeah.
well. And it's like, oh, we need this number, but the comps aren't telling us this
Yeah.
number,
Yeah.
right? And so that comp set is like that's really, really important. And then the other one that's really important, John, I find when it comes to rent comparisons is like, what are they currently getting today? Because
Yeah.
in some cases, they've actually done renovations in the building, and
Mhm.
they've already raised the rents, and they've proven that out. And that was an example that we had in Noonan, right?
That's
Like
right.
our projected rents, they were already doing it. They weren't running it extremely well. That's one of the things we like to find. We like to find operational messes to come in and clean up, and we're looking at coming in and adding amenities and adding more value. And if they're already getting that projected rent, and it was a 3 bedroom that we were able to get
That's right.
before we even closed, like, so they had proven it out. So not only does the comps support it, but in the asset, in the community that you're buying, they've already proven it out. They're looking to exit before they do that value add component. If you can do those two things, I'd say those are like two really low hanging fruit to be able to verify that you're going to continue to get the rents as a starting point.
Yeah. Mark, it's interesting, right? But there's all these kind of fallacies like in thinking, right? And so confirmation bias is a big one. So you
Right.
sort of touched on that where you start looking for all the evidence to support your thesis, right? And I think what we've been really good about is not allowing that to happen. I mean, it can happen to anybody, right? But I think because there's five of us, somebody generally catches it. But one of the things you and I always talked about early on and even to today is I think about it because I've got a 21-year-old and, he's in college, but, he's going to be graduating soon. And I'm like, where would I want my son to live? Like, I want him to live in this one, not that one. It's just nicer. It's got better floor plan, better, ingress and egress onto the main roads, better access. So, if I'm thinking that way, certainly residents would as well. And I think too, really getting clear in terms of our underwriting. One thing I love about our model is it's not just annual; it's broken down on a month to month basis. And so, for example, with things like unit renovations, when we're thinking about our 5-year plan, we factor in seasonality because there are seasons in leasing, right? And so you want to make sure you're not taking too many units offline during peak leasing season for 30, 45 days to renovate them. So we try to renovate more in Q4 and Q1. Now we're still renovating in Q2 and 3, but perhaps 3 or 4 versus 5 or 6. And so putting all that into the model and making sure we're not only thoughtful about, what we think the rent lifts can be, but when can we deliver these renovated units and factoring in seasonality and then also breaking it down by classic renewals as well as those renovated, right? Which then takes us to affordability because that's such a huge factor here because you may be able to get that lift from a certain percentage, but if all of a sudden we renovate a unit and the rent now pushes the affordability beyond that 35% rent to income ratio, then that's the market signaling to us that you're going to have a challenge. There might not be enough people that can afford this, right? So that's another reason we walked away from deals, just simply coming down to the average and the median income in the area. And more recently, we've actually gotten access to some software that we're really excited about because it not only looks at the average and median income, but it breaks it down. So, for example, you might be looking at a submarket mark and it says, "Gosh, there's going to be 10% job growth in this market," but you dig in deeper and realize it's all service jobs. And it's not to say there's anything wrong with that, but if the jobs are $35,000, $40,000 a year jobs, that's not necessarily the type of income we're looking for to support this. So, when it comes to making these decisions, you have to look at a lot of different data points and just really make sure you're not falling into that trap of just we want the deal, right? And being truthful and honest about everything you're seeing in the marketplace.
Yeah, 100%. That income is really important, as you had mentioned as well. And then like another big one is when we're doing our market research is the employment around the area.
Yeah.
That's a big one. We got to make sure that if we have X amount of rent that we're projecting in the future, that there's going to be employment, that we believe that the employment is long term over the hold period. So 3 to 5 years, that's how long we hold our assets. And so if we think that a industry is in trouble, that where it's a little bit more heavily weighted, that's why we like diversity in employment. We spend a lot of
Yeah.
time making sure that there's diversity there so that people will have jobs to be able to pay the rent. that
Yeah.
that's like really important. So you had mentioned an income to rent ratio, that affordability is a big part of it. The other one, John, is like just straight from a visual standpoint in the quality of the comparables when we're looking at them. So
Mhm.
this is really good to actually look at the finishes, like actually look at the quality of the what we'll say of the feel of the units. Like, are they higher ceilings and or not? Like these are some of the things that it would might not even show you on paper from
Yeah.
from that, but you get a little bit newer vintage. You're getting the 9-10 foot ceilings in some apartments. It could be finished exactly the same, but when you walk in, it just feels larger, and that potentially could get higher rent. So when you factor these in, that was one of the things in our Charleston asset,
Yeah.
right?
Yeah.
When we walked through, you recall, it's like, holy geez, these are like really high
10-foot
ceilings, right?
ceilings. Yeah, 10-foot ceilings. Yeah, yeah,
And so this gave us even more confidence when we were looking at the comparables that didn't have that and ours did. It's like, okay, if we're projecting the same amount and we have these extras, that it just gave us that much more confidence, and it all played out, and we were able to overshoot our projected rents. But those little things all add up to making a decision. Yes, I'm gonna, for a resident, saying, yeah, I am going to be paying those higher rents. I think that's a really important factor to look into. And you start to see, like, Johnny, you and I, we've walked through like thousands of properties through the years, selling thousands of homes and
yeah.
properties, and you start to get an eye for the little things that
Yes,
buyers or residents in this case are able to make decisions to say, yeah, is this a home that I want to I'd like to live in, and is this a place that I want to attach what I'm looking at to the price that's being asked for, that I'm going to say yes to that. And all those little things add up to a yes.
that's right. Yeah, so how we stress test this on the rent side is, we wanna look at making sure that we have at least 2 or 3 comps that support that rent lift. Now, in the case of Noonan, as you mentioned, that was a great example because within the building, they had renovated 16 units and were achieving the rents that we're projecting that we'll continue to get. But we wanna also look at a couple different cases, right? So what would happen if, say, for example, we were only able to hit 50 to 75% of that targeted rent lift? What would that model out at? Or if there was perhaps a year where there was something that occurred that we could not foresee, some sort of black swan event, and rent growth was flat for a year. What does that look like, right? And then perhaps if rent lift went negative. Now, I'll say this: we model that, but it's not to say there's nothing that could happen. But at the same time, the markets we're investing in, and I'll use Noonan again an example, projected 12% rent growth in the next 5 years, has 20% rent growth in the previous 10. So it's kind of that idea. You want to know what it looks like and what's the worst case scenario with a potential deal. And these sensitivity analysis and stress tests are very important. But when you buy right, it's not something we worry too much about because once again, the population is far exceeding the potential supply that's coming on. And obviously, things like our debt service coverage ratio, it's got to remain well north of that 1.25 that the lenders are looking for. So if we see in any of these stress tests that we would fall below that, that's a pass. That's an off ramp for us. So yeah, so expenses, Mark. Let's talk a little bit about expenses, right? So the reality is when you get financials from a current operator, you can get them in all shapes and forms. In some cases, you can tell they're highly professional, likely done by a professional accounting group. Everything is very detailed and tagged appropriately. That's most of the time, but occasionally you get some stuff that you'd be shocked. I mean, sometimes there's the kind of quote unquote mom and pop owner, and things are just kind of buried in sort of one catch all, kind of thing like utilities, right? And it's not really broken down by the various providers. And so we can leverage our knowledge of, our acquisition department lead and our asset manager who have done, billions in transactions over the years. But we lean on our property managers in those cases as well. And what are they seeing? What's normal? They operate other deals in the market. So what are some expenses we can anticipate? But for example, the Strawberry Station deal you mentioned, the 36 unit, thankfully we caught this, But for some reason on their financials, they were not accounting for trash collection. And that could be quite expensive. And, so if we had missed that, it's not to say it would kill the deal, but it might have shaved off some of the returns. So you have to have a real eagle eye when it comes to these financials. And then obviously what we like to do is sort of look at, the overall 12-month financials that were typically provided, but look at the trend over the past 3 months. And then we're digging in, we're looking for any inconsistencies. And occasionally, like a leak may have occurred or something. So if you see a spike, that's a question to the broker, right? Hey, we noticed this water spike in September. Can you tell us more about that? But you really have to put a lot of focused attention on what are they currently spending. Now, what we're also looking for are opportunities, right? What we've sometimes seen is they're not charging back for utilities. So there is a RUBS program we can run where we actually allocate a certain amount of the expenses to the residents. To be cautious and clear, you actually have to look at local regulations. Different states and different counties have different rules on how much you can charge back. So we know that information, we account for that. But taxes, right? Taxes are a big issue right now for a lot of operators because during the pandemic, many municipalities froze taxes. And so if you're buying thinking that's going to be the taxes going forward, you could be stung really hard because what generally happens, Mark, is when you close, that new purchase price becomes the value that you're taxed on, right? Now, we work with a third party consultant that runs good, better, and best scenarios. We underwrite to the good and hope for better or best, but we underwrite to good. And then they go in and argue on our behalf with the tax assessor for a lower valuation. But we underwrite to the I guess I would say the worst case scenario, or probably better said, the most likely scenario. But taxes, right? That's a big expense. It's one of the largest expenses in a deal. So you've got to get that right. So working with a reputable third party tax consultant like we do helps us get those numbers right and tight. And then getting multiple quotes for insurance. Insurance is a big factor today, right? Insurance in the United States has just gone up in a major way over the last few years. We've seen an increase in natural disasters and storms. Also litigation in certain markets, Mark. We found that out, and I sort of knew that. I'm living in Atlanta for a long time, and Georgia, for some reason, just has a culture of litigation. And so slip and falls and dog bites and that kind of stuff are a bigger factor here. So because we knew that, we anticipated a little bit higher door costs, and thankfully our insurance came in a little bit lower. Initially it didn't, but we had good brokers and somebody got real creative, went out and found another carrier and got it where we needed it. But what we also look at is we have to assume our taxes will continue to rise. And our insurance could continue to rise. And we have had situations where on our second year, it's gone dramatically down because we operate the deals tightly. But in our underwriting, we assume about a 10 to 20% escalation, right? Like we just write it into the model and hopefully we're delivering good news to our investors that, hey, that didn't come through. But if it does, the model still supports what we've underwritten, of course. And then, looking at payroll, we've seen everything you can imagine from, mom and pop owner who was paying their daughter a $200,000 salary to manage a deal. And we have about 65,000 in payroll. So major savings there, right? So you really have to get granular into those financials and not just trust what you've been delivered. Really go out and verify it with third parties, your property manager, and if need be, even calling utility companies to get quotes to make sure that the numbers are 100% accurate. We also, of course, look at contracts. In this business, you'll have long-term trash contracts, sometimes landscaping, pest control. Maybe there's a laundry facility. We had a deal where the prior owner had signed some 16-year agreement with a laundry provider, right? And thankfully, we were able to renegotiate that. But these things are out there. And so having a full understanding of everything that kind of carries over with the sale. Some of these contracts stay with the property regardless of ownership. And if you miss that, then you may have a major expense that you did not underwrite. So then at the end of the day, put in some buffers, right? Contingency on your CapEx and on your principal and interest. Having that money in reserves just as helpful. So, looking at it in terms of passing and fail, like do we pass a deal or do we fail a deal? It's all about at stabilized occupancy. Are we where we need to be with our DSCR? And for us, we look for break-even occupancy, Mark, around 70% maybe in year one, and hopefully down to 60% by year 5. So that's another way we look at it.
Yeah. So that getting to our last point here is our exit cap rate. So this is something that we do look at. CoStar is a really big, we'll say, platform that we look. They have hundreds of analysts that are projecting each market of where the market's going to be, and they factor in lots like permits that are happening with new construction units that are coming into town, the deliveries when they're going to be coming, and then they look at overall net migration coming in. They look at employment, and they do some really detailed projections as to where the market is going. And so we like to be more conservative than what they project with our, say, when we're projecting our 3, 4, 5 year exit cap rate. So all that is basically it's factoring in what our net operating income is going to be. It's what is going to be divided by to be able to spit out our future value. So that's the beauty with with these multifamily deals, is that it's based on how much income we can generate. If you think about these deals from day one, it's like this gun goes off. We want to make sure to drive up the net operating income, which is you take your overall revenues, you subtract all of your expenses, and then you have your net operating income, which sits above your mortgage payment. Our goal is to drive that as high as possible. And basically at the end, we project, okay, based on whatever that number that we think we can get it to conservatively, if you divide that by what the going cap rate is in that market, then it's going to spit out the value. So for us, we look at CoStar. That's one of the areas that we
Yeah.
factor in, and we do want to be more conservative than it is in the going market. And so we don't want to over project what that number is, because you can get the numbers right up, but if you're way too aggressive on that exit cap rate, it's not going to provide the value that you have written into your underwriting model, and thus the overall returns are not going to be hit when you sell. So that's a really big one that we look at, and generally we're 50 to 100 basis points above the going in cap rate is
Yeah.
generally where we like to be.
That's right. So, kind of now that we've run all these various analysis and done our work, right? It's that independent verification and looking for some third parties to check our work. So that PM sign off I mentioned. So working with our property managers just to review our expenses, review our rent assumptions, review our capex. Over the years, we've developed some very strong relationships with various vendors. Now, I will say that all of our vendors know that on every project we still go out and get multiple bids. It's just good business. But one group in particular who does a lot of our heavy lifting on the construction has really stepped up, and because we've committed to volume, they often have the best pricing. But we look at to them to verify our numbers. This is what we're thinking for our renovation budget. Is this still in line? Right now materials costs are fluctuating sometimes on a daily or monthly basis, right? So, is this still make sense? I mean, I look back at Largo where, and because we've already renovated so many of those units and it's a bit of a smaller footprint in terms of floor plan, we're still coming in under budget. But we were thinking like 12,000 a unit, and that's still holding there. But now we're underwriting like 15.5 and 16,000 a unit because costs have gone up. It's just the nature of it. And obviously, bigger unit just might have more cabinets and countertop space, right? So we have to factor all that in. But getting those hard quotes from multiple vendors prior to LOI, and then going back and comparing against our budget. And then, I mentioned this somewhat prior, but, lender sanity check. One thing about the lenders is they do their own underwriting on these deals. They just don't take our word for it. And sometimes they give us feedback. And there are times where we may have to adjust our underwriting so that we can get the loan approved. But, a good example is, say, for example, you have multiple assets and you're going to share some payroll expense across those assets. Totally appropriate and totally fine. But the lender's going to say, we want you to actually factor in a little bit more here, because what if you sell two of those assets in 2 years and now your expense ratio is going to go up here? So we call it a lender sanity check, but we have great lenders. We work with many different lenders. We find the best lender for the asset, but we've developed some strong relationships. So they give us a little kind of feedback that we can leverage and use to make sure we're making the right decisions here. So it's not just our word you're taking for it. There's multiple groups, multiple people with their eyes on this, just to make sure we're not making any mistakes or stubbing our toes.
Yeah, right on. And then, when we close on it, then it's like the gun goes off, boom, and we're tracking those lease trade outs. So the goal
Yep.
is to renovate something as soon as we can, and then prove out what those projected rents are. And so we don't want to rush it, but at the same time, we'd like to be able to prove that. And that's something that we have a couple of assets that we've closed on within the last, we'll call it 30 days. And so that's where we're nailing that down right now. And so, we've had some organic rent lifts as well, some wins there, but that's something that when that gun goes off, we want to, on closing date, that's where we move quickly. Like we're on the ground on closing day, making the improvements to the property and letting the residents know, listen, there's a new sheriff in town,
Yeah.
and we're rocking and rolling. Get ready because there's value coming to the community.
Well, and to add to that, because we report on our deals to all of our investors on a monthly basis, right? We're on constantly re-engaging with our initial model. And so what we do is we look at actuals and compare against our model. And it's not just, expense, income, and NOI. We go line by line. And so on a monthly basis, myself, the asset manager, and our director of finance look at every property's financials and compare it against our model. And so, sort of like a post-mortem process, we look to see, is there anything we missed, or did we underestimate, or did we overestimate? And so then we leverage that going forward, right? And so it's that idea that, we're not just kind of underwriting it and then working the deal. We're always looking back and, looking for, a potential mistake we made, or once again, maybe an underestimation on something, and then just making sure going forward we're factoring that in. And expenses are something that more recently we've actually added about a 10% buffer into our expenses. Just knowing that expenses are rising, just whatever we think it's going to be, let's just underwrite it with a little bit more, just because some of these, I mean, look at energy costs right now, Mark. I mean, in the state of Georgia, they've raised the rates on our energy, electric, by 4 times in the past year. Now, we don't have to go down this rabbit hole of all these data centers being built and how the cost is being paid by the individual and not the companies. I mean, there's a whole political argument there and a lot of infighting happening as we speak. But energy costs are going up, right? And so just making sure we're accounting for all those things in our underwriting. So that post-close feedback loop is not about that individual asset. I mean, it is, but it's also about looking at all of our previous deals and what we got right, maybe what we missed, and then adjusting going forward, learning from those opportunities to have a better underwriting on each deal that we do subsequently.
Yeah, no, that's so good, John. And that's how mastery happens, right? Is
Yeah,
you go back, you do your after action review, you take your key lesson, learn, you move on, and you go into the next one and the next one. And people ask, like, well, how do you get to where you did? It's like, well, it is through constant and never ending improvement. And that's one of the
iteration.
things
Yeah,
that we're really big on. So John, this was a great conversation, and for all of you listeners out there, hope that give you a really good understanding. When we're going in, we want to make sure that our rent projections are on. We want to make sure to get our expenses nailed down, and then our exit cap rates. If you do those three things, you're well on your way to having a winning deal. Thanks for listening, guys. If you enjoyed the show, you can go ahead and subscribe to the channel, or you can share it with another high net worth investor that you think will benefit from it, that would like to learn a little bit more about multifamily real estate investing. Thanks for tuning in, and we love and believe in you guys. Keep dreaming and investing big.